Hey everyone, it's Zach back with a new mortgage video. Hope you're all having a happy Friday out there. If this is your first time seeing one of my videos, welcome to my channel where I'll try to demystify all things mortgage. If you find this content helpful, like and subscribe. So this was a relatively mild week in terms of news impacting mortgage rates. And as I mentioned in my last video, I had a feeling that rates, after getting better the last 2 weeks, would get a little worse this week. And on one hand, they did get a little bit worse, but on a positive note, it was only due to actual significant news, or at least noteworthy news to the mortgage-backed security market. I'll get into whether it really matters or not, but the days where there was really no news at all, mortgage rates were pretty stable, which has not been the case the last few months. Any kind of negative news, neutral news, or no news has been bad for mortgage rates. So that's a good sign that we're moving the right direction. However, on Thursday, we had some comments from Fed Chairman Jerome Powell at the International Monetary Fund panel. And on one hand, the majority of what he said was kind of the same as what he said last week after the Fed announced that they were going to maintain their rate. But he did mention a few things, like one of his comments was, we've seen a few head fakes from inflation, meaning that it's not necessarily going to go straight down, and that the Fed has not seen enough evidence that inflation is definitely going to go down to 2% without tightening. So on one hand, it was mostly this stance of we're waiting and seeing, we're going to go off the data, and we might hike rates, we might cut rates, it's all going to depend, but the market reacted negatively towards that. And I have a feeling Powell may have been intending to do that ahead of a big week next week, maybe wanting to kind of mitigate some of the swings in the market by tempering expectations. So next week is the opposite of this week. We are jam-packed with economic news, starting with Tuesday, which is the most significant report, in my opinion, affecting mortgage rates. That is the Consumer Price Index, or CPI. And that is the first measure of inflation that comes out each month. And so that usually moves rates more than PCE, even though that's the Fed's preferred measurement of inflation. Now, on top of that, you also have on Wednesday two reports, one on retail sales and one on the PPI report, Producer Price Index, both pretty good gauges of how the economy is doing. And on Thursday, you have another initial jobless claims report. Lately, those have been coming in right around expectations, so they haven't really moved the market much. But going back to CPI, once again, I will have my eyes focused on shelter cost, because that is the biggest component of CPI and PCE. That's the biggest thing that is keeping inflation elevated. And last month, for the September CPI report, we had a very disappointing shelter reading. It only went down 0.1% versus the previous month where it had gone down 0.4%, which made me think that maybe we're going to see the snowball effect that we've seen in rent, which has a lagging effect on shelter. So this month, coming off last month where we were 7.1% year over year, anything I would say 6.85 or lower, I would take as good. If we get a 0.3% drop on average moving forward, that means we'll get shelter within that 2% range that the Fed wants to see for overall inflation within a year and a half, which is not bad. Ideally, 0.4% or even 0.5%. Now we're talking more like a year. But the biggest thing is we certainly don't want a consistent 0.1% decrease or less. That means we're looking at shelter remaining high for 4 years, which would be rough for for rates and the economy. But as always, if you have any questions or comments, shoot them below, or you can call or text me on my cell phone. But thanks for tuning in to this video, and I will see you next week.